Hello, everybody. Welcome along to the November update of the markets from Portal Asset Management. My name is Deryck Graham, and I'm here with, of course, our CIO, Mark Witten. Hello, Mark. How are you doing?
Good in yourself, Deryck.
Wonderful, excited, amazed. That's just the month of November, isn't it? Extraordinary month. A lot of great things happening. We'd love to hear about your interpretation of what's been happening with the market, politics, how it influenced it, what's happening around the world in regards to attitude. So much has changed since the last time we were together doing this show in early November. Over to you, Mark.
Yeah, thanks for that, Deryck. You saw one of the strongest months we've seen in November. I think it was mostly driven by the significant political developments in the US, obviously the re-election of Donald Trump, but more importantly, you had the nomination of very pro crypto policymakers
Yes.
that have come in for key roles in his administration. Not just if you look at who's been running health, if you look at how much influence Elon Musk and Cash Patel and others, they're all very much pro crypto. So this is the first pro crypto Congress we've had, and I think there's been a lot of news out in terms of how damaging Operation Chokepoint 2.0 was, including many crypto founders being debanked and others. And that's changed. So
Yes.
that's completely shifted now to become what was significant headwinds facing the industry on our tailwinds. And I think part of it is wistfully looking back and saying, where could we have been if the last 4 years had been more supportive of the space? So I think that
Yes.
was the first big shift. And then the second big shift was Trump and the US Senator Cynthia Lummis, known affectionately as the crypto queen. They've been pushing the establishment of a strategic Bitcoin reserve. And that would be pretty quick considering they spoke and tweeted about it less than 24 hours after the election results. And the aim is for Q1 2025 to have this set up and running. And if that does come through, there's the likes of obviously El Salvador and Bhutan, but now you're hearing talk of Brazil and other countries
Yes.
also talking about a Bitcoin reserve. So these are players, should you call it, or investors or institutions at the margin that weren't there in any way, shape, or form even 3 months ago. So I think that's another monumental shift that I expect will generate quite a bit of demand. And then the one of the other discussions that have been coming about is how much gold central banks hold, but none hold Bitcoin. So that central banks is different to the US Treasury. And so there's the central banks that potentially will be looking at creating strategic Bitcoin reserves. We even had here in Germany, one of the parliament members, Joanna Kotzer, said Germany also needs a Bitcoin strategy as a store of value to fight inflation. And then we've been speaking about some of the big institutions coming to market outside of the micro strategies of the world and the corporates. And Larry Fink has shown support for this. So we're seeing corporates now figuring out whether they can establish Bitcoin reserves on their balance sheets as an alternative store of liquidity. But now we saw in November, we saw a UK pension scheme, and we're not sure which pension scheme it is. It's a defined benefit scheme, and they invested 3% of their assets in Bitcoin. And that's always been the number that I've had at the back of my head is minimum of one, generally around 3%, a max of five, but 3% of assets between corporates, pensions, providents, insurance companies, and some of the asset managers. And that then, if you look at the valuation of the Bitcoin overall market cap versus the amount of liquidity that'll flow in, you generally, without coming up with numbers and predictions, you generally would say that the trend is firmly up and to the right. It's definitely got more buyers than sellers. So I think those are the big developments. It caught everyone by surprise in terms of the veracity, the velocity of the move on the way up. We had the post-election rally, and then we had sideways moving before we had two of the strongest days in the market. We, as fund managers, were also paid to protect the downside risk, and we had some, call it, zero cost collars in place to protect on the downside. We felt the market might pull back, and that obviously then capped some of the upside for us. We didn't lose money, but we didn't make as much as we could have made. But that's part of also managing risk. You sometimes leave a bit on the table. We also managed to close all the shorts we had. So both funds have been leaning into this market. We've been calling a strong market for more than a year, which we had a couple of months between April and August, which were challenging. But we don't have any short positions at the moment. We very much feel that the momentum is just getting started. And although people are fatigued, it's been a long year, I do feel that going into 2025, we're going to see a lot more interest and a lot more institutional involvement in the space.
Yeah. Mark, I just did a quick check then to try and see just how much the Australian superannuation industry has funds under management. I didn't quite find it, but one has to realize it's some 9+% of every paycheck every day that's generated. And over early periods of time, they were just dedicating their money to the Australian top 200 ASX, which became self-fulfilling nightmare because there wasn't enough stock for that amount of superannuation money to deploy. For those countries around the world that do have a great superannuation system like Australia does, it means there's very large amounts of money in their big superannuation funds. And Australia is investing overseas now very actively and no doubt would hold gold. What happens when you see some of these giant superannuation funds, or for that matter, some of the sovereign funds of the Middle East starting to buy Bitcoin? It must have a pretty clear step-by-step trajectory.
Yeah, I think one of the biggest drivers of growth in the space has been liquidity, the global liquidity cycle, and where that's headed. And there was some chatter over the weekend around a graph that Raoul Powell had spoken about in his global macro outlook, where he was calling for an interim sort of top in liquidity, and then the liquidity cycle would continue to call it beginning of 2026. I think trying to time that is challenging. Personally, I feel given how much every 4 years the cycle has been reset, but given how much printing has taken place over the past, since 2008, but particularly over the past 4 years since the pandemic and the lockdown, we really saw liquidity go almost exponential. And the interest payments right now are, I think, getting close to $1 trillion in the US. So I don't see the liquidity cycle turning anytime soon. I think that's one of the drivers. Another one of the drivers is, as you say, if you're looking for return and you're managing money as a pension, provident, superannuation, whether you're a family office or even just a small retail investor trying to figure out where to put your bets, like putting money into real estate, what's been the return? You're not getting any real yield. Putting money into the S&P or putting money into the ASX, I think personally, I feel that given inflation, I don't think your returns are growing at any real rate of compound. Whereas I think in this space, we can clearly see that there's not only just an opportunity to participate in this technology as it becomes more and more adopted, but I think because of the volatility, there's also ways to extract premium, to extract additional yield, which is what we've been working on for a while in terms of generating more sustainable or stable returns through the cycle. But I don't think that the cycle is going to turn anytime soon. We have no sort of outlook in terms of pulling back risk for the short term. I think over the next 12 to 18 months, it's to me very clear that there's going to be a lot of capital coming into the space from sources we haven't really even thought about yet. As you mentioned, sovereign wealth funds. With oil where it's at, countries like Norway, obviously many countries in the Middle East, to an extent Russia, if it manages to get back into the SWIFT system, they have serious amounts of capital that'll be looking for liquidity and looking for yield. And what would you be buying in the face of this, in the face of where this technology is growing? Because that's really what it is. It's a new technology, I think, that is more disruptive than the internet, as far as I can tell, as far as the work we've done. This is one of the biggest developments in finance that's happened in the past sort of 50 years.
So, Mark, what's interesting is that people have often said that in times of war, maybe Bitcoin will have very little interest, or maybe Bitcoin will become the go-to asset. Certainly, we've seen in Russia and in the Ukraine that they are in the top 5 users of cryptocurrency, both for the same reason. If they need to escape the destruction that's happening in their country, then they just go across the border and no one knows they've got their assets sitting in Bitcoin. And same occurs in both countries. The other thing that's happened that's interesting is that, as we all know, that war has escalated, but the price of Bitcoin hasn't gone down, despite the war escalating. So it may well be that other factors have influenced it, but that binary view that if there's a war, then there'll be a Bitcoin sell-off hasn't shown to be the case. Has it, Mark?
No, I think partially because it's such a global market that isn't subject to the same constraints in terms of supply chain. You tend to have big moves in commodities that could, like oil, etc., that could be affected by wars in certain regions. Whereas I think by its very nature being decentralized, what happened in 2022 when China mostly exited the Bitcoin miners and most of the mining capacity then moved globally, that was a very good thing for the market. It's made the market more resilient. I think also
Yes,
if people wanted to move and leave and go somewhere else, whether it was to flee a war or to look for a better economic opportunity somewhere else, all they need to remember is their passphrase, right? That's it. You can recover it and you've got your capital on your phone. So that, I think that's the big change that people have come to realize is after they were bailed in certain instances is that you own the crypto, no one can take it from you, and it's accessible globally. So I think that's part of it. But I think the underlying drivers right now, geopolitical risk notwithstanding, which is concerning because I do think that there's been this push to escalate it, which is not in the best interests of the globe. But I think that it's the global macro in terms of the buyers, much bigger buyers that we haven't really seen in the space before that are coming in. It was more retail driven back in 2020, 2021, when you had the summer of DeFi and the explosion in NFTs and so on. You're now moving to a much bigger bulge bracket in terms of institutional allocation. And I think the legitimization of the asset continues to grow. I think Bitcoin is finally being seen for what it really is, which is not just a store of value in digital gold, but also as a means of accumulating wealth. Where I think for a lot of younger people, if you look at what the average salary is relative to home prices and so forth in terms of like how many years, it used to be when I first started out, it was maybe 3 years worth of your gross salary or 4 to afford a decent apartment. Now it's more like 8 or 9. So I think people are also given up on the concept of finding some secure corporate job, working for 25 years and somehow paying down a mortgage.
Yes.
And I think people are looking for ways that are, how else can you continue to take part in this? Because DeFi and smart contracts, which is the next order effect, they're continuing to get smart and continuing to grow. Right now, we've been focused on where we see liquidity flowing, which will be into Bitcoin, to an extent ETH and Solana and a few of the other big tokens. But ultimately, we've been concentrating more of the fund into Bitcoin as we find other ways of extracting yield on it and trading it through the cycle. I think that's the main point, is you want to hold it through the cycle while you continue to build.
That's it. Maybe we can talk about that, Mark, because what we have discovered along the way and what we've just talked about there is that the sovereign funds, the institutional investors, the giants, the ETFs are arriving. They're not arriving to buy Ripple. They're arriving and buying Bitcoin. The sovereign trusts and the sort of the reserves of the world aren't going to be racing to buy necessarily Ethereum or Avalanche or Cardano or some layer 1 protocol or layer 2. They're looking at buying Bitcoin. And that makes Bitcoin stand all by itself. And its seasonal upside is, I think, so much more compelling than the big runs and bursts that we have in this market. So one of the things, of course, we've done as a team, and you've worked on a great deal, is how do you own Bitcoin and how do you build upon that at a far greater rate than you would if you just bought an ETF. And that's what we've been working on for some time. And in this month, we've released it. So maybe, Mark, talk a little bit about that. And by all means, instruct me when you want me to jump a slide.
Thanks, Deryck. Yeah. So, we've been working for some time on repositioning the fund in terms of how do we manage both volatility and risk, but also extract yield. I think that's a big part of it because of the volatility and the fact that you've had this very choppy market. We have a firm belief that the price of Bitcoin will be much higher in the future, whether it's 1 year, 3 years, 5 years, or 10 years. We don't really have a time frame because we want to be in this game indefinitely. And as such, if your core holding is Bitcoin and there's a very much an active options and futures market that's developed over the past few years, it wasn't as deep and liquid as you would have liked, call it 5 years ago, but it's developed nicely over the past 2 to 3 years, and you actually have a very tradable options and futures market where we've worked on a strategy where we can extract roughly between 5 and 7% per month in yield, and then that compounds on a monthly basis. To put it into context, if you start with 1 Bitcoin and you're growing that at between 5 and 7% a month, you're pretty much doubling the amount of Bitcoin you hold, What the capital price does, Bitcoin could go from, let's say it's trading at 96,000 today, it could go to 150 and then come back to 100. And your return for the year would be 0% if you just held the Bitcoin. Whereas implementing the strategy, if Bitcoin goes even trade sideways, choppy throughout the year, theoretically we should have 2 Bitcoin by the end of the year. So if Bitcoin doubles in price, obviously you get that 100% return as well, but then you're compounding your returns. And I think that's the point, is we've taken a long view on the asset and we've said to ourselves, we want to build wealth in this space. And the way to do that is to continue to accumulate Bitcoin and build on that base. And I do believe that there'll be more participants, particularly now where you're getting options on ETFs and potentially indices, and those are continuing to grow. ETH's actually had a solid ETF. So I do think that we'll also be able to implement the strategy across potentially ETH and Solana, but Bitcoin at this point in time is where we're generating quite a bit of success in the strategy. The two things that need to be bear in mind is that the strategy it has been back tested quite a bit, and we've been running it live for the past, call it 2 months, initially on a very small size, and now we've started increasing it. So in November, we really did pivot the fund. Like I said, we after the Trump victory, we closed our shorts. We got rid of probably about half our altcoins, kept the largest and most liquid, and we put about 65-70% of the fund now into Bitcoin, where we will be trading the strategy and continue to accumulate it. What we do believe is over time, you'll have that compounding effect. So every month you're adding a small amount of Bitcoin incrementally. So even when the market comes down, we actually like it when the market comes down because it enables us to continue to implement the strategy, but actually pick up more Bitcoin with the P&L as well. I think the longer view is that we would hope to potentially double the holding of Bitcoin we have on an annual basis, irrespective of market conditions. And there will be times where the premiums do dry up a bit, so you might have slightly less. And there'll be times when the market's volatile and there'll be more premium to be extracted. It is a very low risk, sort of short dated strategy, so we're not taking tail risk into the fund. We learned that lesson with the zero cost collars in November, where we're trying to mitigate the risk, not expecting Bitcoin to go up 25% in a month, sort of thing, in less than a month, in a week. And that's what the strategy works. If you look at the performance relative to whether it's some of the other funds, obviously the other indices, gold and so forth, the back testing has been very solid, and I do think that going forward, what will make the strategy stand out is how it potentially will be. It's the compounding over time. You have that compounding effect over time as you incrementally just generate more Bitcoin. So it is quite an intensive strategy in terms of time spent. You need to spend quite a bit of time trading it and focusing on it and running it and managing your risk and managing the book from a short dated perspective. But I think the returns are without taking on any additional risk to the portfolio, I think we can easily generate around 70 to 100% net of fees, excluding the performance on the underlying market, which I think is quite special. So it's been a long time in building this out.
If you wanted to have one token, go away for 5 years, live on an island and come back, what would it be? It will always be Bitcoin. No one will choose another token because they just don't know whether it will be there in 5 years, be in favor in 5 years, dominate the market or disappear, because the top 30 tokens have changed so dramatically over the last 5 years. But we've seen Bitcoin continue to grow. So part of that strategy is the fact that if you want something that the sovereign nations and governments are going to be investing in over the next decade, then it's going to be gold. It's not going to be Pepe or Dogecoin or a meme coin. If you want to speculate in the next 30 days, maybe that's it. Maybe it's Pepe. But in regards to what we want to do, our goal is to continue to build Bitcoin at a rate of that around 100% per annum. And then we expect to see some of these things that Michael Saylor has been talking about occur. Some of the things that Cathie Woods has been talking about occur. And that's the growth in Bitcoin's price to an extraordinary level. So we're certainly dedicated in. One of the things that we talked about, Mark, is the fact that there are so many alpha-seeking, high-volatility funds out there on the market. And we've shown a few of the best here in this graph. And they basically all do the same thing. They just all hunt alpha during the highest volatility period. And one of the things that I thought was very important is that you generate wealth right through these crypto winters that go for such a long time, or when crypto goes sideways to generate wealth. So anyway, that's the rationale of thinking. We'll keep everybody up to date with that. We will be reporting on a monthly basis, not just the US dollar value, but also the number of Bitcoin that we've increased from what the previous month did this month, both as the number of Bitcoin and as a percentage. It's interesting, Mark, how we all consider a reverse back, how we value something. It seems to always be based upon US dollars or our Australian dollar if we're here. Australian real estate has done incredibly well in the last 4 years. It's up 40 to 45%, depending on where you are, when you compare it to Australian dollars. But if you compare it to Bitcoin, it's actually down 76% in the last 4 years. It's a different rationale of thinking. And I think that's what a lot of the younger generation looking at going, we'll never own a house, not unless we invest wisely and trade well in this space. And certainly that's something we hope people will have in their portfolio. Seasons are still an important part of the whole thing though, aren't they, Mark? And we will need to trade this right through the seasons, but in some seasons that means pulling back into some stable coins. Maybe talk about the seasons where we might be up to now. And there's a slide showing the seasons now.
So you're going to have natural ebb and flow of liquidity as we've generally always had. The economic cycles tend to be between 4 and 7 years, depending on which cycle you're looking at. I think in this space, though, the halving tends to create an imbalance in supply and demand, and that tends to give you some impetus from a buying perspective in that there's less supply coming on. I think that the main factor to bear in mind is at this point is once again that global liquidity cycle we spoke about and where we see interest rates going. And from our perspective, that is indicating that we're still in for a bit of a summer. I think we've spoken about it in our last newsletter. I think Trump has inherited, unfortunately, a bit of a dysfunctional economy. I think there's a lot of geopolitical conflict, and as such, they're going to need to stimulate as well as continue to cut rates. I don't think demand side inflation is there. So I think that when the cycle does begin to turn and we see that potentially we're due a blow off, and the challenge this time around is that there are so many more participants in the space that there's more of a natural buyer. A lot of the ETFs will be set up, or investors in the ETF will be set up on a monthly basis. Most people, most normal people, most working class people don't have a lump sum to invest. Yeah. So they'll take a percentage of their salary every month and put it through, whether it's a pension, a provident, or into an ETF directly. And that becomes a natural buyer. So I do think that might mitigate the cycle. And I also feel that as Bitcoin corrects this time around, there's a lot more people interested in accumulating a decent position. And then there's the likes of, as you say, the Michael Saylors of the world that are issuing debt and equity and will continue to do. He's bought in the last, I think, 2 months, he's bought the entire amount of Bitcoin expected to be mined next year, if I'm not mistaken. That's how much he's looking at accumulating. So there's a huge supply and demand imbalance. That being said, though, timing the market is I've always said, it exists to make astrology look respectable. It's a very difficult thing to do. Most people don't get it right. You can time the macro, and often the macro and the micro don't. There's a disconnect sometimes for months at a time. But what you can do is you can continue to build on a strategy where, you know, even if the price of Bitcoin is coming off and you maybe have taken some of your portfolio to cash, you can continue using that Bitcoin as collateral and continue to generate the yield that you're looking for. And you're suffering impermanent loss. So it's a capital drawdown, but it's not, you haven't lost the money. You still own the Bitcoin. You're from a performance perspective, the returns aren't great. But then as you can see, as an example, you would have gone from $79,000 all the way back down to $50,000 in the past year. But then you're now doubling up. So at that 50,000, you still would have been continuing to grow the yield, grow the amount of Bitcoin you have. And I think that's what you need to bear in mind is either you believe in the longer term, which we do, that Bitcoin is going to continue to attract investors and will be at some point in time, I would say, like multiples in terms of price of where it is right now. In which case you want to try own as many of them as you can as the price comes off. I think that's the main thing to focus on, is that the cycle has got a long way to go. The season will be summer for, I think, hopefully at least another 1.5 to 2 years, but it might be even as long as 3 to 4 years.
It's very difficult because the circumstances of Bitcoin, the demand side of the equation has changed. and it's not going to change back in a hurry. It used to be demand driven by speculators and some whales and institutional investors a little bit, but now it could well be that government is the demand side. And so we might not see quite as much pullback as Bitcoin as we have in the past. So we don't know that, but there's logic that would suggest that's the case. Mark, have a wonderful Christmas. I'll see you in January. For our listeners, have a wonderful Christmas. I hope you enjoy watching what happens over the crypto period in the month of December. And we'll be back in January to report on the month and also now to report on the process of building Bitcoin and where we stand with that. Merry Christmas to you all. Bye for now.
Cheers. Merry Christmas to all.